Good morning, my name is Lindsay Goodwin, and today we are going to be looking at 5 corporations in which we're going to determine who we will give a short-term loan to, a long-term loan to, and who we are going to be investing in. So like I said before, we're going to look at first our short-term loans, who we will pick top and then second. We'll be looking at our long-term loans, also who will we pick first and then second, and then our equity acquisition, which is who we will be investing in. So today's 5 corporations are going to be Jacobs Engineering Group, Primoris Service Corp, Plains All-American Pipeline, Spectra Energy Partners, and Johnson & Johnson. For our short-term loan, we're going to be looking at the corporation's current ratio, which is current assets divided by current liabilities, and we're going to be looking at their cash ratio, which is their cash divided by their current liabilities, and this is found on their balance sheet. So our scenario for today is you are a corporate investor with $100,000. Each of today's 5 corporations come to you asking for a $50,000 6-month loan. You must lend to at least one as an investor, but a max of 2 viewing your available capital. So today I made a graph to show you their cash ratio versus their current ratio, and then you can look among each of the companies and see who is higher according on the graph. Or if you see, I have some highlighted boxes which show the yellow is going to be the top picks, and then the orange is kind of they weren't the best, but they're still pretty good. So the higher the cash ratio, the more liquid the business is, and we want our current ratio as high as possible in order to pay short-term creditors. However, too high means the firm may be inefficient with cash and other short-term assets. So my top pick for today is going to be Johnson in giving a short-term loan to. I picked Johnson because they have a high cash ratio, and even though their current ratio is a little bit lower than Jacobs, it's still pretty good. And then I would also pick Jacobs for my second option because their cash ratio is a little bit lower, but it's still also good, and then their current ratio is high. So now we're going to move on to our long-term loan. We're going to be looking at time interest earned, which is our EBIT divided by our interest expense, and we want this as high as possible. We want to look at their total debt ratio, which is the total debt divided by total assets, and we want this ratio to be low as possible. And then we're going to look at their equity multiplier, which is your leverage, and that's going to be your total assets divided by stockholder equity, and we want this as low as possible. So our scenario for today is you are a corporate investor with $1 million. Each of today's 5 corporations come to you asking for $500,000, a 5-year loan, which is 60 months. You must lend to at least one as an investor, but a max of 2 viewing your available capital. So again, we looked at these 5 companies and we mapped out all of their time interest earned, equity multiplier, and their total debt ratio. So what are these numbers we're looking at here? So first off, I highlighted the best ones, and then the orange is the next best. They weren't great, but they're still really good. So the higher times interest earned ratio, the better able the firm is to fulfill its interest obligations. That is very, very important because we want to make sure that they can pay us back over that time. We want to get our money as an investor. Now, a high equity multiplier indicates the company has been using more debt than equity to finance its asset purchases. So we want that to be a low ratio. We want less of the debt. For total debt ratios, you want below 1 because otherwise you have too much debt, and 0 means you have no promises. So anything closest to 0 is good, but really close to 1 or even over 1 is not good at all. So when you look at the chart here, you can see that I picked Jacobs first because they have the highest interest earned and they're going to fulfill their obligations with me. Now their equity multiplier is not as low as the other corporations, but it's still good. And then their debt ratio is also, it's not as low as Primoris, but it's still low. So in the end, I picked Jacobs to give a long-term loan to because they're going to be more obligated. And then secondly, I would have picked Primoris because they have a really good equity multiplier and a really good total debt ratio. Their time interest earned isn't that great, but it's still really good, and I feel if Jacobs denied the loan, then I can give Primoris the loan and they would still fulfill it. It might take them a little bit longer, which is okay. Today we're going to look at the equity acquisition as our last, which is we are going to invest in one of these 5 corporations. So you are a corporate investor looking to purchase stock in a company. Each of today's 5 corporations come asking you to consider them for your equity acquisition. You must acquire at least one as an investor, but a max of 2 viewing your available capital. We're going to look at the ROE, which is your equity multiplier, and your ROA. Now you want your equity multiplier to be low, your ROA to be high, and then we're going to turn over into our profit margins and asset turnovers. So as you see in the graph today, there are yellow blocks all over the chart. Everybody's doing good in something, but it all has to dwindle down into who is the best. So first, we need to look at the higher asset turnover. It is going to be our more generated sales. The higher the profit margin, the better off the company is doing. The higher ROA indicates asset efficiency. A high ROE means the company is increasing ability to generate profit without needing as much capital, and it also indicates a company management is deploying the shareholders' capital. That is a very important number to be looking at. A high price earnings ratio tells us that firms have significant growth opportunities. So overall, I found that Primoris Corporation is going to be the one I want to invest in because their asset turnover is high. Even though their profit margin is lower than Plains and Spectra, it's still really good. It's not a bad profit margin. Now, the return on assets is wonderful. And then the return on common equity is a really good, really high number. So that is much interest to me because that means they're giving out the shareholders' capital and the company's management is doing great. And then their price earnings ratio, it is a little bit lower compared to the other companies, but it's still a really good number. So I picked Primoris first to invest in. Now my second pick would be Jacobs. They're not so bad as some of the other companies. They still have a good asset turnover. Their profit margin is a little bit lower than 3 of the companies, but it's not bad and they're still growing. Their return on asset is second best. Their return on common equity is a little bit lower. I give them credit on that, but it's still a decent number. And then their price earnings ratio is high, not as high as 3 other companies, but it's still pretty high. And I believe that they are going to grow and they're going to keep doing very well.